Hi, welcome to this webinar on what financial reports does your board need, ensuring the mix fits your governance needs. I'm Ruth McCambridge and I'm the Editor-in-Chief of NPQ, and we're very pleased today to welcome Hilda Polanco to lead us through a webinar on the exciting, very exciting world of board financial reports. And the fact of the matter is, the sad thing is, both Hilda and I actually do believe that board reports are exciting because there are ways to do it very right and ways to do it very wrong. And Hilda's going to try to discuss with you today some of the differences that you have to observe and some of the samenesses that you have to observe from one governance situation to another. I do want to say at the beginning of this that we are having kind of serious technical difficulties in that the whole 4 blocks around our office is out of internet access. So we are sitting in the lobby of a hotel doing the very best we can. The first thing that I do want to say, just in terms of why this comes to you free, because it is a very high quality session, is that we've got a sponsor, AccuFund, and AccuFund provides award-winning software solutions for nonprofit and philanthropic organizations. And those solutions are either cloud-based or on-site. But you should check them out. They've been very generous in making this free to all of you. Secondly, as we move through this, you'll notice on the right-hand side, bottom right-hand side of your screen, it says tweet us, hashtag Hilda on Finance. And we would love it if you guys would tweet during this session so that we can get out and about the wisdom that she will impart to us. We will potentially be taking questions at the end of this session. Hilda has a lot to cover, and so we're going to see how things go. We did get some questions ahead of time. But for now, we are planning to take questions at the end of the webinar. So just to go back to what it is we're doing today, I don't know how many times I've heard complaints from people about how little their boards understand about their financial situations and about their, you know, they'll ask crazy questions in the opinion of an executive or a treasurer or a CFO. And in a lot of cases, that is not the fault of board members. It's the fault of badly designed reports and badly chosen reports. And so what Hilda's going to talk to us about today is exactly what reports do you need in what circumstances, what kinds of reports have what capacities. But she's going to start us off with one story that we've talked about quite a bit. So Hilda, take it away.
Thank you, Ruth, and welcome everyone. Happy to be here with you to cover this very exciting topic. The story that Ruth refers to is one that unfortunately has really taken the sector by surprise. And earlier this year, you may recall an organization that was in business operating under the name of FEGS. And this was a $250+ million organization serving the human services sector in New York City in many, many different ways. It had many years of history delivering high-quality services. And on a snowy Friday afternoon in February of this year, FEGS closed its doors. And it was a shock to our system in the New York City area. And it raised many questions about how could this have happened? How could a board, as well staffed as that board was, not see something like this coming? How could the staff, the leadership team, not see it coming? And it'll be years before or if ever anyone really identifies all of the causes or how could it have been prevented. But I think one critical issue, and this is not an opinion on that organization specifically, but what we see when we see situations like this question of how could that have happened and we didn't see it coming, is this question of what were the questions being asked by leadership, by management. And when we often find ourselves working with leadership and things have gone astray somewhat, this question between board and staff usually goes something along the lines of the board member will say to the leadership, you never told me that, and you can complete the sentence. And leadership will often respond by saying, well, you never asked. It is somewhere in between. We as leaders want to make sure that we're bringing to the attention of the board what we believe is critical, where we see risks, and where we want board focus. And on the board, and I'll use we interchangeably because most of us probably also serve on boards, there's this question of, am I asking the right questions? Board members want to keep the conversation at a certain level, and so does staff. So what I hope we'll accomplish today is help you navigate that and help you stay in the right context of what the conversation should be. At FMA, we've developed what we call a strategic financial management framework. It's the framework that we believe leaders and boards should be working through to keep the conversation at the right level. And the framework really has 4 parts to it. We believe that for organizations to succeed in delivering their mission, they have to have strong planning processes. And you'll hear quite a bit from me today through reporting on how planning is so critical. We have a plan, we know where we're heading, but we have to check in on that. So the monitoring function of an organization becomes absolutely critical to see if we're on track to those plans that we've developed. And of course, another word for monitoring is reporting. So today, I'll highlight the value of planning and where boards should be focusing on the planning side, but we'll deeply focus on the monitoring side. This framework we see as a continuous process, thus the circle and the ongoing arrows in the process. Inside the circle, we call that the vicious circle. The fiscal operations is where a lot of attention goes, unfortunately. Boards are frustrated, they're not getting the information they need, management feels like they're doing mental gymnastics to get the information that the board wants, and the teams are so focused inside the circle that you almost lose sight of what's important, which is outside in the planning and monitoring. And in this framework, you can see that we believe governance is at the helm. The boards are there to help, they're there to guide, and we often think of governance as compliance, right? Our boards need to make sure we have annual audits, file our 990s, and that's absolutely true, and many states now require separate audit committees, so I am in no way de-emphasizing the role of the board in governance on a compliance level, but today's focus, and I think from a sustainability perspective, the focus needs to be beyond compliance and more on the financial health of the organization. So from where we would like to focus today, we want to talk a little bit, or I'd like to share with you a little bit of the things that the board should be thinking about with respect to financial health and strategy. How does an organization work to have its leadership and its board work together around something that we would determine to be the long-term financial goals and plans? We'll often ask organizations, so what are your goals for the year? And we'll hear things like, we want to double the number of classes, we want to increase our geographic footprint. We don't always hear things like, we want to increase our reserves by 5%. We want to diversify revenue by X%. So what we think is critical is that the long-term financial goals of the organization are an integral part of the plan. And they would cover things like, what is the full cost of programming? How much do we need to raise for each individual program, not the organization as a whole? But one of my favorite terms in the whole wide world is the concept of depreciation and how all that fits in. So we won't have too much time to talk about depreciation at length, but I will just say that if your budget does not have depreciation in it or some capital replacement component, we're probably at risk. So we want those strategies to plan for the capital needs and think about how those will be funded. Another very important what we consider financial goals is this question of operating reserves. The operating reserves, we see more and more conversation since 2008. Those organizations that had reserves were able to respond to the unknown or the unforeseen. And those that didn't really may not be around today to really talk about it. So as organizations did survive 2008, there's a more focused approach to what are these things called reserves and what are the policies. I often will say that if I pick up an audited financial statement and it says we have board designated reserves, that to me tells me there's a board that's thinking. Another board 5 years down the road might decide that was not what they want to focus on and they want to redirect funds. But the fact that the board is exercising its ability to segregate funds for specific purposes is a great indication that the board is thinking about how to allocate costs or reserves and policies for that. The infamous rainy day reserve. We see situations where an executive director will want to tap the rainy day reserve because in her mind or his mind, it's raining and the reserves are needed, and the board might think, well, that's not really rain, that's only drizzling. That's not what we had in mind. And so clarity around why we have these reserves and their use is really, really critical. And the scenario planning. We have a budget, it's a plan, it's approved, but what are the chances that we can foresee every possible scenario in one budget? We know we can't. And so we'll often talk about plan A, plan B. What are those scenarios that you and your board are thinking about before you approve your budget? And then finally, this question of multi-year planning. I have here 3-year financial plans. If they turn out to be 2-year financial plans, the key in setting this focus between board and staff is this idea that each year we approve a budget. We're not only approving this year's budget, but we're making commitments that will affect next year's budget. So if you approved a COLA, for example, a cost of living adjustment for your team, that means that next year's budget will require, assuming same workforce, will require X dollars more to just keep your doors open. So we might think of commitments that are around leases. Maybe we have a funding cliff coming up. In 2 years, that grant will disappear. Well, we don't want to wait till that year to start thinking about it. So you can see that this menu here of financial goals, the conversation on this sustainability level and not get into maybe whether we're doing this type of supplies or those types of supplies. And once we have those goals, what we want to do is make sure we have a way to monitor them. And in the monitoring process, setting what we call key performance indicators will be key. You'll see when we talk about reports, it's about monitoring the right things, the things that are important to the leadership and board, and we often hear the term KPIs. So key performance indicators are KPIs, a very common term these days, and it's around performance management. What's important to us? How will we measure it? How often will we talk about it? And what will we do if things don't turn out to be the way we thought? Lastly, from a monitoring place, I want to introduce the concept of forecasting. When we spend time, and many of you with us today, I'm sure, have written budget to actual variance analyses, and we spend endless hours justifying why life didn't turn out the way we thought. Why in a situation where the actual didn't agree to the budget. That's a budget to actual variance. Well, in reality, there's a good chance that it'll never turn out the way we thought. So while we have a budget and we begin the year that way, forecasting is about the future. And so at least 1 quarter or even halfway into the year, the board really needs to accept that we have variances from budget and understand them, but focus on the future, which is forecasting. How will we end the year? What are the drivers? What can we do? How can we course correct? And that's where we hope the reporting and the communication will help. We see the reports as a tool for you to monitor your focus, to think about how are we going to achieve the goals we've set for ourselves. So think of that process. We've got our financial goals that I've just introduced to you, and you may have others. We have revenue concentration and predictability. What is the biggest #1 risk in most budgets? It's not expenses. We have a way of spending what we plan to spend. We have our payroll and our overhead, and those are the significant captions. And so it's pretty easy to predict those, a little bit harder to predict the revenue. And for just a second, I want you to close your eyes and think of the last budget that your board approved. And ask yourself, is this a budget where revenues and expenses are exactly the same? And therefore, we're successful. We have a balanced budget. Well, if you do the same exercise and you think about your latest or the audited financials in your past, and you ask yourself, how often were revenues and expenses exactly the same dollar? I would venture to say most of us would say never, or very rarely. And what that really tells us is that we make our budgets balance. We make revenue usually equal expense, and the difference is what I would call the soft number, right? The number that we're going to raise. And that is a key point of risk and for partnership between leadership and the board. If I approve a board, if I have a budget as a board member, and I don't know what percentage of those revenues are soft, are to be raised, I've really approved a budget without understanding my risk. And so in the reporting, we highly recommend that you think about how will you be transparent, the leadership and the board, how will we both know what are those soft numbers and how can we stay on top of that. And that's really a marriage between finance and development to always know how far are we on that soft number. So we're going to look at those risks and design reports to tell us how we're doing. And then we're going to look at the expense structure. Are there any risk areas? Are there areas where we might have some challenges if we don't meet plan? Lastly, what is that program delivery model? Where are the risks? So we're asking ourselves those questions, and we're thinking about reports that help us answer that. And so Organization A, for example, is focused on academic performance, and the organization has government funding. We all have some of that, and we understand that government funding comes with certain risks, one of which is cash. It always arrives, it just sometimes arrives later than we hope. And so if I'm Organization A and I've set my financial goals and my plans, my financial monitoring plan might focus around things like cash flow and looking at receipts carefully, looking at my payables, how am I doing with an operating surpluses. I'm going to keep my eye on that revenue mix and am I diversifying enough. I'm going to look at how programs are doing. So from this organization, that would be guidelines for me to develop my reports. Organization B, on the other hand, might be more focused on, maybe in this example, it's a theater. And in that case, it's not about government funding, it's about multi-year funding and reserves that the organization might have if our fundraising is not as consistent. One thing with government is there is a level of consistency with multi-year contracts that we don't have with ticket sales or fundraising. So for Organization B, our planning and monitoring is probably going to be more around what is our fundraising level, what are our unrestricted or temp restricted net assets, reserves, what's my revenue and sales mix, how am I doing with my pricing on my sales. So the key performance indicators are going to be different for each of these organizations. So the plan has to lay out what's important for us and what will we be measuring. And when we do that, we need a set of financial reports that different managers will use throughout their work. And I lay out a few examples here that we're going to dig into, especially the Board of Directors list. But I encourage you to think of financial reports as following the organizational chart. So if I'm a program manager and I have 2 or 3 programs under me, I should be receiving reports from my programs that I'm directly responsible for. I should be receiving budget to actual reports on my grants that I'm responsible for. So at the program manager level, we're focused more operationally on the programmatic activity. At the executive director level, we're going to be thinking more at the organizational level. And the balance sheet, which is also known as the statement of financial position, but the balance sheet is really critical for the board to see, as you'll see, but for the executive director. It's not just about budget to actual, but what's my cash position? Where am I at risk with some of my liabilities? And so you'll see examples of what these reports could and should look like. As an executive director, I need to see those forecasts for the year-end projections. We constantly want to be thinking about where will we be at the end of the year. Again, not only budget to actual, but what can we do to meet those goals? And then lastly, cash flow. You'll see I have an example for you today that I call the executive director's navigation tool. When the executive director gets that phone call, and we all know what that phone call might be like, a grant has been delayed, a grant has been postponed, the ED should really be in a position to within, I don't know, give it an hour or two, know what that means. Sometimes that's not so bad. We can weather that storm. Other times that phone call might be catastrophic because it's the 1 month where we're otherwise really low. So that cash flow projection is the navigation tool for the executive director and board, obviously, if we have a tight cash flow, if we're organization A. As far as the board of directors, you might say, wow, they have the longest list, and they do, and that's because they're thinking of the organization holistically, and they also are thinking of other types of, or they should be receiving other types of reports and tools that will help them. We'll go through each one, but just very quickly, I'll talk about the management narrative, the balance sheet and supporting schedules, the budget to actual for the organization, the projections, the cash flow, and we'll touch briefly on the performance dashboard. So if I were thinking of a model board package, let's just go down this list that I've given you. The first is the management narrative, and I want to say a couple things about this. It shouldn't be more than 2 pages. It should highlight critically the things that are important. It should be addressed to the board or maybe the finance committee of the board from the executive director, usually drafted by the CFO, but maybe jointly with the executive director. And it should be issued within a month, 3 weeks to a month of the financials when they're being issued, which for boards is typically quarterly. You may have more often, but I don't suggest that they be less often than quarterly. So on a quarterly basis, we have this package. It's my favorite component of any board package I review, which is the executive director is telling me what's on my mind, what's important. And for many boards, there's a partnership, there's an agreement that this memo will cover these 4 areas because this is where we see the risk for the year. Again, we have these, you'll be able to download these, the PowerPoints, and if you actually wanted hard copies of a sample memo, we'd be happy to follow up if you request it through the download. So we've got the sample memo. Again, not too long, just what's critical, so you can focus the concentration of the board on what is important. Otherwise, the board will look wherever they think they should. And I'll just admit also that as board members, we have maybe 30 minutes to review the financials. So how do you want your board to spend those 30 minutes? This is what that memo will do for you. In terms of the financials themselves, there's a statement of financial position which is absolutely critical and should be the leading document in these financials. They tell the organization's leadership, where are we? Where are we in terms of asset position, liquidity, cash, all of the assets that we own. But I want to pay particular attention to the net asset section. This represents the net worth of the organization. It represents whether we are an organization that's been in business 100 years or we started 3 years ago. This is the accumulation of resources over time, or the depleted resources if you've in fact had what we would call accumulated deficits. But in this picture here, we have a $1.8 million organization in terms of net assets. And if that's all that we saw, 1.8, you would say, well, that's a pretty healthy organization. But in fact, by breaking this out, we see that the one is really all in buildings. And while buildings are really helpful and we need them to run our organization, not really easy to cover payroll on Monday with a building. And so the liquidity aspect of your unrestricted net assets is absolutely key that the board understand of the 1.8, how much is really liquid, and not just the board. When you're presenting your financials to funders, particularly if you want to make it clear that the reserves are in two sections, there are buildings and then there's the operating, you want to be clear as to how much is available for operations. So the 1.8, we have operations of about 100,000, and then we've got our buildings. On the temporarily restricted, those are donations that have come in over time, and they're restricted in purpose, and it's really important to understand its composition. At times, we actually recommend an analysis of what's in those dollars. And interestingly, many of the questions that came in towards today's webinar were around this question of grants and restrictions. So I'm going to come back to that in a minute. But I want to focus on the one line that we called operating here. And at FMA, we've come up with a really inspiring term, and it's called Lulla. It reminds us of the solar system. It's optimistic and it's sound, and it really represents our liquid unrestricted net assets. And Lulla is a number that we now see more and more boards using as their radar for liquidity, as their radar for financial health. We actually see boards sort of rallying around this one number, because at the end of the day, if your yearly operations leave you in a stronger respect to Lulla than you were at the beginning of the year, you've had a successful year. Maybe not as successful as you wished, and certainly you can plan for more, but the goal is that every year's operations strengthen, or at a minimum not deplete your Lulla position, because your position in Lulla is what's going to help with unexpected downturns, new opportunities, capital requirements, all the things that organizations need. So to build a campaign against around strengthening Lulla, absolutely strategic position to take. The calculation is here. There are different resources we'll point at the end of the webinar that you can use to calculate your own Lulla. But suffice it to say that most lenders and others in the field would like to see 3 to 6 months as a position. Now, I'm often told if I have 2 weeks of Lulla, 3 to 6 months sounds pretty overwhelming. And so the way I think about Lulla is what would it take for your executive director to be able to sleep at night? Is it 1 month of payroll? Is it 2 months? Is it 2 months of rent? What is that number that if we had it in liquid available resources, your executive director could go from crisis mode to what I would call strategic thinking? If we can achieve that, we're at a minimal level, whatever that number is, and then we work from that. So again, think of Lulla as this one place where it all comes together. If we've had losses, it depletes it. If we've had surpluses, it strengthens it, and that's our guard against or for the future. Specifically on the balance sheet, we have some corresponding supporting schedules that, although at times people will say, well, my board doesn't need to see what's in receivables, and maybe that's true. Your board may not each and every receivable, but your board should know at a minimum what is the total receivable, how old are the receivables. I think one of the challenges that FAGs and some other organizations have had is that they had receivables that ultimately were not collectible. And so for a board to even have a sense of how old are the receivables, as you can imagine, the older they are, the harder they are to collect. So we've seen, whether it's dashboards or summary totals, we need to know what's in those numbers, particularly because for many organizations, receivable turns to cash, so if it's aging, it will never get there. The flip side of receivables is payables. Again, does the board need to know how much we owe Verizon? Probably not. But the board should know how of the total payables, what percentage is in what category? How old are they? Is our landlord on that list? Or hopefully never is the IRS on that list? Who's on the list? How old are they? What are the risks? I think that's an important part for the board to know. How you communicate that, to what level of detail, that's for you to decide. But the key is the position, how old and what are the dollar amounts. So remember, these are all supporting schedules to that balance sheet that we talked about that the board should be seeing. I'm now venturing into my revenues, right, in my budget to actual. This particular format is a current period actual compared to the period budget and my variance, and then my year-to-date. And I wanted to make a specific point around this question of year-to-date and how a budget, if built properly, can really become a spending plan. So if I give the opportunity for my program directors to give me my budget spread over the 12-month period, that's my spending plan. And if I incorporate all those budgets across the programs into an organizational budget, then when I see my budget to actual, this you divide it by 12, and there's really no business logic to the period to date budget. We want that budget to follow how we originally planned to spend the dollars. And so the way that the year-to-date budget is built is really critical. I want to bring your attention to the third line in the revenue category, and that's called restrictions. And one of the biggest components of, biggest points of confusion and points of why sometimes board reports do not agree with audits or just lack of understanding is this idea that we receive grants over time, and those grants have restrictions. Sometimes they're for purpose restrictions, specific programs, it's time. But as far as an operating budget, which is what we're looking at here, we only have a certain portion of those grants available for this year's budget. Subject of a different webinar, but I just want to say that this is the one time where you actually have two sets of books. And I know how frightening that can sound to someone. There are the GAAP books, which are based in generally accepted accounting principles. And then there are the operating books. And they're based on the same principles, it's just that the presentations are different. What we want to make absolutely clear is that we, the leadership, and our board knows how much do we think we're going to satisfy this year, when do we think we're going to satisfy it throughout the course of the year, and then recognize against it. So you can see that satisfaction has a budget and it has an actual. And in this case, it looks like for this month, we thought we were going to satisfy, we were going to deliver services that had been restricted in funding by 25,000, and we only did 20. That is the key to the confusion, and again, we could spend more time on it, but I just want to highlight that if your systems are not connecting those two, prior year donations with current year satisfactions, you're going to have confusion, and unfortunately, more dangerous than confusion is risk that you may not satisfy everything, or that you may use the funds in an appropriate way. So we've got our year-to-date budget and actual, and certainly in that narrative we should be highlighting how we're doing against it. The other aspect that I had mentioned is the idea of the forecast. And so as the year progresses, the board might see a comparison between the original budget and the year-end forecast. Where do we think we're going to end the year? Or you may have a main decision that the board adopts and then monitors against. I'm often asked the question, should I have a budget revision? Isn't the budget and it never changes? That's an organizational culture answer. Some boards will never change the budget. That's just the way they grew up, so to speak. And others recognize that a plan changes, and if it's significantly different, we should be modifying the budget. And in modifying that budget, it should be properly approved by the board in that way. So how often you modify it, that's the board decision. My point is make sure that you're focusing on the year end, that there's a forecast in the mix so that you can continually, in this case, the budget provided for a surplus of 68,000 in my example, and this forecast is telling us we're going to be in a deficit of 74. As you might imagine, if we were leaving ABC here, we'd want to totally understand why the variance and how can we course correct so that that 74 does not become a reality. I want to mention in the previous reports, we were looking at budget to actual organizationally, and this is for the organization as a whole also, but we also want to think about these reports by programs. And what really this brings to bear is this idea that for nonprofits, we have what we call multidimensional accounting. We have to think of it from a budget line item. We have to think about it from a program perspective, from a grant. Some organizations even worry about location. So if I'm tracking all these things, I have to have the accounting software to help me track that, and I have to have the allocation plans to have that. And that does some software that's out there that's not fund accounting, QuickBooks, for example. It might be a bit tricky to get this done, but there are ways to customize QuickBooks so that you can get these multi-dimensions. Not as easy as with a fund accounting package, but whatever package you have, it would be too risky to say I can't track this because my software can't do it. You also don't want your staff spending endless hours with Excel manipulation to get them. So there's a happy medium by maximizing the software and what it can do for you. Back to my navigation tool. This is a cash flow projection tool, and we'll share with you a website later at the end of the session where you can download at no cost a tool. This is the tool actually. And the cash flow projection tool, which again is built and you can download and get started this afternoon, gives you the ability to spread your revenues equally or differently. You can decide expenses. It's a partnership for the leadership team. The expense is really simple, right, as you might imagine. Spreading that, again, the hard part is the revenue. So this allows the finance team to build the expense together with program, and the development team to build the revenue. And they're there for the partnership. When the development director sees that in the month of January, 90,000, so if the state contract for 110,000 doesn't come in, we have a significant issue. That's what management is about. And the development function, being at the table with those discussions is really critical. I know that on this tiny screen, this may feel overwhelming in size, but it's the wonder of Excel. What I wanted you to show you on a more sort of focused basis here, there's something called the rolling cash balance, and it's at the very, very end of this very all-encompassing schedule. And as a board, I want to see my first subtotal, the excess or shortfall from operations. Am I bringing in enough cash or not, month by month? And then capital. Am I repaying loans? Am I purchasing equipment that may not be in my operating budget? And the most important balance is the rolling cash balance at the end. So red is not a good thing. And when red appears in the rolling cash balance, we have no such thing. We cannot overdraft the account. So it's built in partnership at all levels. We have a tool that can help organizations really think into the future. And I often say, as an executive director or development director, if you call your funder and you say, in December of next year when we're supposed to receive your grant, we think we're going to be in trouble, or even 5, sure, is there any way that you can advance us the grant? Foundation will probably be proud of you that you're 5 months in advance able to identify it. If you call the foundation and say, if I don't get the next week's check on Monday, I can't meet payroll, that's a very different conversation. So the ability to know what's going to happen in the future or project is what this is all about, and a very helpful tool. The bringing it all together, the management narrative, the balance sheet, budget to actual, year-end projections, cash flow, and then last but not least, the performance dashboards. If you Google the term dashboard today or tomorrow, you will have thousands of entries. It's a really sexy term these days. And organizations are trying to figure out what's a dashboard, how do I build it, how do I think about it. Think of it as something that complements your reports. It doesn't replace them. But for most board members, the reports that I've just walked through might seem a bit overwhelming if they're not as user-friendly as they would like. The idea of the dashboard is to take the information that's there and then measure it against some targets. And so you want to make sure that there's performance against the targets. Again, you see the term KPIs again, that you understand these targets could be against last year, it could be against the budget. What are we actually tracking and what's important to compare? In terms of the decisions we're going to make, a lot of the decisions we make are around risk management. If we don't achieve this, what will we do? So I've included here just a few for you to see how decision making can be supported by dashboards. And these are just some examples. These are Excel-based. The idea is to keep it simple so that the energy goes into the action on the outcomes, not on the sheer preparation of them. They should be, over time, not very difficult to produce. So of course on the top left-hand corner, we're recommending tracking Lulla and how are we doing against our target. You can see year-to-year results. You can see that dashboards can be not only financial but programmatic. So here we're tracking the programmatic enrollment in the youth program or the cost per outcome if that's something that you're focusing on. So that's one example of a dashboard, more like charts and graphs on Excel. You might have a different dashboard that's not charts and graphs at all. It's simply a listing of what's important to us and a target. In this case, the months of liquid unrestricted net assets. Last year this time we had 2.2 months. We've defined, these targets are self-defined, so we've said if we're over 3 months, we are meeting, we're exceeding our target. If we're within 1 to 3 months, we're within the target, and if we have less than a month, we're off target. And the legend here, you can see the red, green, yellow, and I would imagine we all understand when we use which. And so I can tell right away, it doesn't take much analysis for me to know that we're in trouble on the program costs. And we're starting to hit trouble in Lulla, and we're doing really well with operating results. And of course, those are all fantasy numbers, but for an organization, you would want to see, so what does this mean? How do I course correct in that? Lastly, I just want to say that the opportunities are endless in terms of what a board could track on dashboards. It's not about volume, it's about focus. So I've got 9 different identified more, and each of these areas has, for organizations, may have a priority, may not. But overall, this just gives you a sense, hopefully it sparks some ideas for you as to what might be the KPIs in each of those areas. And again, this is just the beginning to have you thinking about that. So just to again summarize, dashboards, consider it a tool to help in the conversation. I've just talked about how valuable they are for boards. They're just as valuable for management in terms of tracking the KPIs and tracking what's important. So I am going to turn it over to Ruth and to see if we have, again, I have some questions that were submitted in advance. Let's see if we have some questions that we can address right now. Questions like, can we download the slides? Yes, as part of the follow-up through the webinar, you will have a link to download. Has it been recorded? Yes, recorded, and you will be able to download. Some of the questions that I see here, if we operate on an accrual basis, should all of our reports be produced that way? Absolutely. So I'm going to say absolutely we should have an accrual basis set of financials, and absolutely we should report that way. The only report that I've provided that should be on another format is the cash flow, because that is all about cash. So otherwise, we're dealing with accrual. How often should these reports be presented to the board? I think quarterly. I envision the reports being developed and presented to the Finance Committee, and the Finance Committee reviews, approves, is comfortable, and then they're presented to the board. Let's remember that the Finance Committee champions finance, but they're not the only ones that are responsible and should be knowledgeable. The Finance Committee really is a spokesperson, the owner of that. So will prior years or opening statement of financial position be helpful at this stage? I would imagine that if you have had sort of significant variances from year to year, or if there's something you really want to track against last year, your systems have all this information, so comparing to what did the balance sheet look like last year, it may be helpful, but sometimes it isn't because so much is based on timing. So I'm going to say you decide, but it is something that many organizations do. Remember, the more comparison you do, the more information there is to get through, so you want to make sure you're looking at the ones that give you the most focus. So I see one that's let's see. We have 2 months of very high expenses and 10 modest months. When figuring 3 to 6 months of operation, should we be counting the greater ones? Great question. You should take your annual expenses and divide that by 12 and come up with the average amount. And so in that way, you have the average for the year, and that's what you have set aside. Having said that, if the disparity in some of those months is really significant, a more conservative approach might be 3 months of those really, really heavy months. I think that may be difficult depending on where you are. That would be a more conservative way to go about it, but I usually see 1/12 being put aside for that. And I mean that with depreciation, and some organizations do it without. That's, again, how you think about capital. Another question, may we hear again the definition of the line satisfaction of restrictions? So on your balance sheet, you at the end of, if you've received donations or contributions, I should say, that are restricted to the future, and that restriction could be for purpose, this is to run the after-school program, or for time, this is a multi-year grant. That's a restricted grant, and at the end of the year, you will have temporarily restricted net assets. When you go into the following year for operating budget purposes, if I have a 2-year grant for the after-school program, I might have only $100,000 for next year, maybe $200,000, but I only get to spend $100,000 in year 1. The operating budget should only have $100,000, the amount that's available for that year. Satisfaction of restrictions on a budget represents the amount for that year. And so you need to plan for that, and then through the accounting entries you would recognize how much you have satisfied in that year. So it helps you plan that you're spending what you were supposed to spend and at the rate that you were supposed to spend it. Next question, is there a risk in too much information to the board? How to manage it? I think that there is a risk. More isn't better. The financials that I showed today, I think, are a critical set. If you were to exclude some, I would say I don't want to give any of them up. Perhaps the cash flow, if you don't have significant cash flow, but to the degree that you are at risk with cash, we can't do without that report. And the rest really represent the entire picture. I think the key is to identify the risks in that memo or otherwise. What are the areas where we might have a financial challenge, and make sure that those are addressed. And that's why that partnership with the memo at the beginning of the year, 4 things that worry us the most, and then focusing on that will ensure that we don't find ourselves with too much information and without enough focus on the important items. So a question here, I'm having a hard time determining the target goals for the KPIs for my industry. What are best practices? So targets are more, I would say that they're based on your peers. And so the first part to setting targets and benchmarks outside of your own organization are is first determining who are my peers. And peers, there's lots of information available on GuideStar for organizations, and you can identify, if you know who your peers are, you can go and find the financial analysis for organizations that, that you've identified. If you are in the arts world, the CDP helps you compare against peers, the Cultural Data Project. But outside of those two sources, the one next area that I see be very helpful with benchmarking is associations or advocacy groups that, for example, in New York City, there's a Human Services Council. There might be the Association of Human Service Providers. And so find in your community what association you are a part of or can be a part of. And I think in the sort of work that we're doing nationally to help folks assess their performance against others, we're recommending that federations, for example, opportunity for organizations to report in data and then be able to compare to their peers. But there's no such thing, there's no such publication that's going to give you all these answers, especially as you get into questions that are not available in publicly published audits in 990s and things like that. So I hope that was helpful. Next question that I see here is, can a board approve a deficit budget? Absolutely. A budget is a plan, and a deficit is can be a plan. The key is that it be a planned deficit, especially if you've had years of fundraising for a particular goal, restricted or otherwise. And then here's the year. Here's the year we're going to accomplish that goal, where we will be using funds raised in the past to use in this year. And that will look like a deficit. It will be a board-approved deficit, and that's absolutely acceptable. I think it's understood that deficits will happen, but did you have a reserve? That brings me back to why Lulla is so important. Did you borrow to fund that deficit? Not a good place to be. So this question of deficit, obviously the trend, multi-year deficits is not a good thing as you deplete your reserves. But in a given year, any board can approve a deficit. It's within their power and absolutely acceptable. Okay, someone heard that depreciation is my favorite term, so I have a question on depreciation. How should depreciation be accounted for in the operating budget? So we often hear folks say depreciation isn't real. It's a non-cash item. It's this thing that the accountants do at the end of the year. And that's true. The accountants audit, a component of the audit is to make sure that the depreciation is right. But it's beyond the audit. Depreciation is your wear and tear on the assets that you have. And so the way that you would include it in the budget is there would be a line called depreciation, and that would be based on your latest audited numbers. Maybe there's a new number for this year because we made significant additions in the past. So we have a number, and it's $25,000, and that's our depreciation. And we put it in the budget as an expense line, and hopefully we have a balanced budget or better, right? Balance is not success. Success is positive. So we have a surplus of some number, but that already has expenses of $25,000. At the end of the year, there's no vendor that will show up and say, you owe your depreciation payment. Everybody else shows up. Depreciation does it, which is why it's forgotten. So you're your own vendor for depreciation. At the end of the year, that $25,000 has been raised, and we have it. But if we leave it in the checkbook, we haven't really done what we need. So we keep the $25,000 in the checkbook, let's say, or we do this monthly, and we then transfer that to an account, and that account is called the capital fund. So we've raised the money, we've identified it, we've transferred it to a capital fund, and now we can plan accordingly. So that's the way that depreciation flows through the budget and then is the basis from which you can invest in whatever fixed assets you may need in the future. So I hope that helped. Another question around grants. how do conditional grants best appear in reporting? And conditional grants are grants that will only be real if you have met a condition from a funder. So if you do this, we will grant you this. So conditional grants typically do not appear in the financial statements. Internally, they would be best reported as a footnote, or depending on how critical it is, if you need board engagement to satisfy the if part of that equation, a challenge grant, for example, you may have that as a risk area in your cover memo. But it would not be reported until you meet it. And once you meet the condition, it's reported like any other grant. Wow, these are all such exciting questions. There's another one here. Our board likes to see an expense burn rate. I average this over a rolling 12 months so that those months with expense anomalies are represented. Okay, and that's an interesting point. The burn rate, though, especially if you have financial investors on your board, they think of that as the monthly cash requirement, the monthly burn rate. And so what an average is a good way to do it, to give them a sense. You know, our average monthly rate is 100,000. Back to that other question we had, if 1 month it's 100, but 3 months out of the year it's 700, then it might be important to highlight those peaks and valleys. But in general, unless you have those extremes, the average monthly burn rate is a great rule of thumb, because as we're watching the revenues that are coming in on a monthly basis, we need to know what's our target, and that's an easy rule of thumb to know that we're going to be able to cover.
Okay, I think we're going to have to wrap it up now. I don't think I have ever seen this number of questions come in for any webinar that we've ever done, and we certainly broke a record for the number of attendees, which was up around 700. So obviously this is an incredibly popular topic, and Hilda has done it justice, but enough justice for 1 hour is probably not enough justice. So I think what we'll commit to at this point is bringing Hilda back for a number of other webinars, if she'll agree to that.
Accepted.
Yeah, and specifically I think we want to do something on dashboards, but we're going to look over the rest of these questions and make sure that we try to ferret out what are the constellations of issues that we should do more on. So let me just
I just want to point one more, the last slide in the PowerPoint, if we can go back to the PowerPoint. I just want to point you in the direction of that resource that I mentioned. StrongNonprofits.org is a website, literally StrongNonprofits.org is the URL. And I've highlighted for you the governance section. If you go into that section, you will find very helpful tools for board leadership. And in the planning section, you will find that cash flow template that I mentioned, in case that was something you wanted to implement right away. So I just wanted to.
I do want to mention to people that the very best way to make sure that you're notified of future webinars is to sign up for our newswire. Once you're on that list, you will be notified of everything we do. So you should go to the NPQ website immediately and sign up for the daily newswire. And then you will remain on our list for everything. And you won't miss one of these coming up. So thank you very, very much for coming. Again, this broke our records, and I hope that it was very helpful to you. We look forward to any suggestions you have for future topics, and we will talk to you soon. Thank you.
Thank you, everyone.